Assalamualaikum. My name is Muhammad Umar bin Muhammad Nizam, and my number matrix is 17 DIF 24 F1053.
My name is Muhammad Wakil Wajdi bin Muhammad Sabri, and my matrix card number is 17 DIF 24 F1005.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Aizat Farhan, and my matric number is 17 DIF 24 F1033. And today I and my team will discuss about accounting source document and accounting principle. Assalamualaikum warahmatullahi wabarakatuh. I am Aizat Farhan, and we will discuss about source document in accounting. So, source document in accounting is related with accounting chapter 1 and 3. So, most of the source document were related with some accounting principle that was historical cost, objectivity, full disclosure, or matching. They also were related with accounting assumption that was separate entity, going concern, monetary unit, consistency, and accounting period. Alright, now I will show you some example of the accounting source document and we will discuss about it. The first one is invoice. So, invoice was related with accrual concept, where it was used in credit transaction and was issued by sellers. Like in this invoice, we can see that Senjam Berhad was selling some furniture to MTI Berhad, and this invoice was issued by Senjam Berhad. The next source document is receipt. So the receipt was related with accrual concept. This receipt was used for cash and check payment, and it was issued by payment receiver. Like in this receipt, we can see that this receipt was issued by Persis Yang Berhad, and their customers is MTI Berhad, and it was recognized as revenues. That's all from me. I will leave the discussion to my friend.
Assalamualaikum. Now I will be discussing about the importance of source documents in a business. First of all, receipt is issued by a seller to the payer. It is for payment by cash and by check. Vouchers is for payment that has been made, but the receipt is not given by the seller. Memos is when there is an increase in capitals, drawings, or other extraordinary event in the business. Checkbox is evidence that payment has been made by check. Sales order is used to general sales invoice. It also used to create the sales invoice to customer on the product delivery. Purchase order is first official offer issued by the buyer. It is to control the purchasing of products and service from external supplier. Checked is when we order a bank to pay a specific amount of money from a person's account to another person, and checked that has been issued. Furthermore, invoice is for credit transaction only, and it is issued by the seller. Cash bills, however, is for cash transaction only, and it is issued by the seller as well. Credit notes is to inform the buyer that his account has been credited. It is issued when sales returns or sales price is overstated. Debit notes is to inform the buyer that his account has been debited. It is used when sales price is understated. Moving on, there are 7 types of journal: purchase journal, sales journal, return inward journal, cash receipt journal, return outward journal, cash payment journal, and general journal. However, I will be explaining 6 journals instead. Now, purchase journal is used to record goods purchased on credit. The source document is invoice received from the supplier. Sales journal is to record credit sales. Invoice is received from account receivable. Return outwards is to record transactions involving any purchase return. Credit notes were sent by the supplier. Return inwards journal, however, is to record transactions involving sales return. Credit notes is issued by the customer. Cash receipt journal is to record all cash receipts from any source. Cash receipt and cash register summary. Cash payment journal is to record all outflow of cash from the business for any purpose whatsoever. The source document is payment voucher and checked bud. Now you might be wondering, how does the source document look like? Here is the example of a debit note. Like I said, debit note is to inform the buyer that his account has been debited, and it is used when the sales price is understated. In this debit note, one of the accounting principles in these examples of a debit note is objectivity. That's all. Thank you. Assalamualaikum.
Assalamualaikum warahmatullahi wabarakatuh. I will now discuss about accounting constraints. First, conservatism. You must avoid overstating asset and revenue or understating liabilities and expenses. The second, materiality, refers to the relative importance or significance of an item or event. Lastly, benefit and cost. Cost of preparing accounting information must not be exceed the value or benefit of the information. Now I will be discuss about internal user. First is management. Second, current investors. Second, business owners. Fourth, marketing department, and lastly, finance department. Okay, next about external user. First, bank or financial institutions. Next is government and suppliers, and lastly, employee unions. Okay, now I will be discuss about accounting cycle or process. First, source document. Second, book of original entry. Second, ledger. And fourth, trial balance. 5, adjustments. 6, adjusted trial balance. 7, financial statement. And lastly, financial report. Okay, now I will discuss about cash bill. Okay, this is example from me and my team. So, what is this? What is cash bill? Cash bill is a document that serves as a receipt for a transaction in which payment is made immediately in cash. It typically includes details such as first, date of transaction. Second, seller information. Third, buyer information. Fourth, description of goods or services. 5, amount paid. 6, payment method. So, cash bill are important for both buyer and sellers as they provide proof of purchase, help in accounting, and serve as a record for tax purpose. Unlike credit sales, cash bills indicate that not further payment is on. So, this example issues by PC Sdn Bhd as the sellers, and it were recognized as revenue. So, next about credit note. So this is example of credit note. A credit note is a document issued by a seller to a buyer, indicating that a certain amount has been credited to the buyer's account. It typically arises in situations such as first returns, second overbilling, third discount or adjustment. Credit notes are essential for accounting and inventory management, as they help track adjustment in sales and ensure accurate financial record.